John Callow is Senior Currency Strategist, Westpac Bank, live out of Sydney. Dr. Marc Faber stays with us from Hong Kong, editor, publisher of the Gloom, Boom and Doom Report. He's our guest host this Monday. Gentlemen, both of you, thanks for staying with us. Dr. Faber, let's pick up where we left off. You were saying that you were looking for the global risk trade that we've seen to come off. You're looking for a correction. Let me ask you the three most important questions, I guess, and that is, when's that going to happen? What are the triggers going to be, and what magnitude correction are you looking for?
Well, these are three good questions. I think in general markets were very oversold on March 6, 2009, and there were some favorable technical divergences in the sense that many markets and many stocks in March, when the S&P made a new low, were far higher than they had been last October and November. In other words, some stocks had already entered bull markets, including the Asian stock markets. Right now, many stocks have risen by more than 100%, and the number of stocks above the 50-day moving average reached 90% the other day, which signals a very overbought position, certainly in the United States. And so I expect now a correction to unfold. Whether the correction is actually the resumption of the bear market, where we will make new lows, or just a correction, that still remains to be seen.
You're not sure?
I'm never sure about the future.
Okay, that's probably a wise thing to say. Sean, do you see that happening?
Well, we certainly do think the whole green shoots arguments have been very much overplayed, and that personally I think it's very important to bear in mind just how far a lot of economies have fallen, how far they've got to get back to even where they were a year ago. Japan, for instance, fallen by more than 9%, almost 10% since Q1 last year. And if you think, and during the boom years, 2003, 2007, they only averaged 2.1% growth, then it's really an incredible hole that they have to dig themselves out of. So I think there'll be a lot of frustration as the months go by with the pace of recovery and the absence of V-shapes in most economies, and that would certainly be a setback for asset markets.
Mark, all the ratings uncertainty that we saw last week with regard to the UK and the US economy, is that going to hasten the correction that you were talking about earlier?
Well, I mean, I think the market is to some extent already pricing in the fact that the US government bonds are no longer AAAs or no longer very high quality, especially if you look forward. And as I have maintained in previous writings and interviews, I think the US government will eventually go bust, massively so. But it's a question of time, and as long as you can print money, and as long as somebody is willing to accept that money, you can postpone the ultimate hour. But I think the problem really is that it will be in future very, very difficult for the US government to reduce the colossal deficits they have piled up at the present time. At the present time, the way I see it, the fiscal deficit this year will be minimum $2 trillion. And next year, I think it will be very difficult to bring it down below that figure.